Hey everyone, it's Julie here with Tip Ranks. Today we're taking a look at two trending tech stocks that have been dipping in price lately. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at a couple names in the tech sector that have been trending on Wall Street. They are some of the best rated stocks in the past week, meaning they've been picking up a lot of buy ratings. But both of these stocks are down over double digits over the last few months. So we're going to take a look at these companies, what's been going on with them lately, and see why Wall Street thinks this might be a buy the dip opportunity. We found these stocks on the Tip Ranks trending stock page. Found underneath research tools, here you can find the best, most, and worst rated stocks over the last 72 hours, 7 days, or 30 days, and narrow it down further by market cap and sector. You can check out the trending stocks right on the Tip Ranks website or on the mobile app, which you can download using the links in the description down below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Now let's dive right into these trending tech stocks. First on the list, we're looking at Marvell. They trade under the ticker MRVL, currently priced just above $74 per share. In the past year, they are just down 4%, but when we look year to date, they've dropped 32% from 52-week highs of $127. They are ever so slightly in the green over the last 3 months. Marvell creates high-performance semiconductor chips and solutions that powers data infrastructure. This is used in applications like data centers, AI, 5G networks, automotive systems, and enterprise networking. Their custom silicon processors and networking chips are used in cloud computing and AI workloads, helping support hyperscalers like Amazon. And their chips are also used in in-vehicle networking, autonomous driving, and infotainment systems. Marvell has been facing headwinds like tariff fears and margin pressures from their ASIC mix. Concerns around Marvell's ASIC mix mostly revolve around customer concentration, margins, and competitive positioning in the AI and data center markets. Their business is heavily dependent on a small number of large clients like Amazon, and they typically have lower gross margins than their standard networking or storage chips. But AI networking demand does remain strong, and the demand for Marvell's new products is beginning to ramp up significantly. Looking at KPIs, their data center segment is experiencing remarkable growth, driven by custom AI silicon programs, with revenue surging 78% year over year. And in their last quarterly earnings report, they did have both an earnings and revenue beat, with revenue surging 63% year over year. They saw record revenue of $1.895 billion and also made significant stock repurchases of $340 million. The lowlights did include their consumer revenue going down 29% year over year, though 50% growth is expected in this next quarter. But that quarterly report came out at the end of May. So what has Wall Street analysts suddenly weighing in on the stock recently? Well, just yesterday, they had their custom AI investor event, where they announced some new hyperscaler solutions. Their event underscored deepening and broadening traction with hyperscalers, new design wins, advanced memory and power architecture innovations, and a robust addressable market outlook. And in the short time period following that event, we've already had plenty of Wall Street analysts weighing in, including a 5-star analyst from Bank of America who increased their price target while reiterating a buy rating. They said that Marvell has a strong and diverse pipeline with significant opportunities in custom compute and XPU segments, which are expected to drive substantial revenue growth. The company has expanded its customer base and increased its number of unique sockets, indicating a robust demand for its products. Marvell has received 24 analyst ratings in just the past 7 days and has 31 current ratings altogether, coming in as a strong buy with 27 buys and 4 holds. The average price target comes in at $90.21, implying an upside potential of 21% from current prices. And looking at those most recent ratings down below, they do range from a downside of 2% with this hold rating here to an upside of 74% from JP Morgan. And for our second trending tech stock today, we're looking at GitLab. They trade under the ticker GTLB, currently priced at $41.85. They are just down 2.4% overall in the past year, but when we look at the last 6 months or year to date here, they're down about 25% from highs of $74 back at the start of February. GitLab is a web-based DevOps lifecycle tool. They offer a single application that leads to faster cycle time and allows visibility throughout and control over various stages of the DevOps lifecycle. They help organizations plan, build, secure, and deploy software to drive business outcomes. GitLab has been facing headwinds such as increased competition and uncertain customer demand. Their latest quarterly report just came out last week. While they did have a revenue beat, it was their smallest beat yet, and it was their first quarter where they didn't increase their future guidance. Revenue did grow 27% year over year to $215 million, and they did see momentum with their GitLab Duo continuing to grow. However, the company did say that there was slower growth among their smaller and mid-sized customers, and that the macroeconomic environment remains cautious, affecting deal timings and procurement decisions. But the company did also highlight their success in free cash flow, generating over $104 million, resulting in a record adjusted free cash flow margin of 49%. With GitLab dipping in price, there is one popular investor that's already been scooping up stocks. That is ARK Invest's Cathie Wood. It was reported last week that ARK Invest bought another 227,000 shares of GitLab. There has been plenty of Wall Street analysts weighing in on the GitLab stock following that earnings report, many of them reiterating buy ratings, but they also at the same time are lowering their price targets. They said that the Q1 report was disappointing, with a relatively meager revenue beat and no change to full-year guidance. They noted a higher SaaS mix and back-end linearity contributed to the disappointing results, but healthy RPO metrics indicate that underlying momentum remains strong, and they believe GitLab's best-in-class DevOps platform can still coexist with rapid adoption of AI coding tools. The stock has 24 current analyst ratings, coming in as a strong buy with 20 buys and 4 holds. And the average price target of nearly $63 implies an upside potential of 50% from current prices. Looking at those ratings down below, we can see a bunch coming in this past week, many of them lowering those price targets, but relatively all of them still have double-digit upside potential. On the low end, we have 7.5%, going all the way up to 103% upside. So that is a look at 2 tech stocks that have been trending with Wall Street analysts lately. Both still have some headwinds that could impact their stock, but Wall Street seems bullish that there's turnaround potential in their future. So let me know your thoughts on these companies in the comments down below, and if either one catches your eye. I always appreciate hearing from you guys. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock, so make sure you always do your own research and due diligence before making any investment decision. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.